Thank you, Laurent. It was interesting to listen to some of the points made by the two colleagues from Spain and France. They were concerned about the new approach of inspections without notice in Spain and the compulsory involvement of the public prosecutor in France. Now, interestingly, both things have always been there in Italy, and I think Italy has always been a place of concern for tax investigations. The first topic is the selection of investigated entities. The Italian tax authorities publish every couple of years or so guidance on this matter, but those criteria are so wide in scope that they are not really helpful in understanding whether a given entity will be inspected or not. More meaningful, I think, is the size. And it's interesting to see that we have essentially three categories of enterprises. The small ones, which means revenue lower than 5 million euro, mid-size, which is lower than 1 million, and large enterprises, which is beyond 100 millions. Sorry, I meant, of course, 100 millions. This latter category is made of approximately 2,000 enterprises in the country, and they are regularly inspected. Probably not every year, but every 2 or 3 years. A company of that size should expect an investigation. For mid-sized enterprises, it's a random basis, so it's very difficult to say. We have noticed that companies with a significant amount of cross-border relationships are more likely investigated than others, but it's just a feeling. This is not necessarily a real factor of selection. And then we have the small enterprises, which might be the case of small subsidiaries of large groups, because the enterprise is taken individually. And in this case, Italy has introduced a few years ago an indicator which is called fiscal reliability index, like a mark of reliability of the data based on internal consistency checks, etc. And companies with bad marks are more likely to be inspected. Thank you. What are the topics? Now, I think this resembles a lot what we've heard from the other countries. What I would like to focus on are the peculiarities of the Italian approach to these matters. So for permanent establishments, it's not unusual that the Italian authorities detect a permanent establishment inside a subsidiary of a foreign company. It's what it's usually referred to as the embedded permanent establishment. And to have a more clear idea of the case, reference could be made to the points you see mentioned there of the OECD commentary on Article 5, which was actually drafted many years ago following the very famous Italian Philip Morris case, which is still something that tax authorities have in mind in many inspections involving multinational groups. And then the other area concerning PEs is the agent PE, because we have a relatively old network of treaties and we have not yet implemented the MLI, but still case law and, by the way, the approach of the tax authorities is to some extent go beyond the language of the treaties in force and adopt a kind of BEPS-inspired concept of agent PE. So looking at persons playing the most important role in the execution of contracts and looking at them as agent PEs, regardless of whether they have the legal or de facto power to execute agreements in the name of the foreign enterprise. Inspections of this kind are most frequently based on questionnaires sent to the customers and asking, who is your contact point for that foreign enterprise? And if the answer is this person living in Italy, that will be the starting point of an agent PE investigation very frequently. Then for transfer pricing, I don't have anything really special to mention. Of course, management fees are very frequently inspected, as well as business restructuring, especially for large enterprises. The transfer of function, risk, and assets is very closely inspected. When it comes to corporate reorganizations and M&A, there is a trend in addressing the interest deduction in leverage transactions, and of course, a very wide application of anti-abuse rules in mergers and demergers, which are tax neutral, and often this neutrality is challenged under the reconstruction of the transaction as something else. Other frequent topics I'd like to mention, and I think Marina has already mentioned concerning Spain, is withholding taxes. Beneficial ownership requirements are very closely looked at by the tax authorities, as well as procedural rules. We have very tight regulations on the timing of the certificates. So a late certificate is equivalent to no certificate. And we have a lot of controversies about that, and very severe penalties applicable. And finally, from the VAT side, there is an approach by the Italian revenue in denying the deduction in the case of dealings with missing traders, which might not simply be related to a fraud, but also in less critical cases of missing traders. I would like also to say that the topics are often unpredictable, and if I may, I have brought two examples in the next slide of two situations in which it would be really difficult, would have been difficult to say in advance whether that rule could have been applicable. Next slide, please. Thank you. The first example on the left-hand side of the slide is the plain case of an Italian company selling goods to an unrelated Italian client. So a domestic transaction between unrelated parties. Now, I think it would be difficult to think of the application of transfer pricing in that case, but there are precedents in which transfer pricing has been applied on the argument that the agreement between the two Italian companies was actually agreed between the foreign parent companies. This is a very frequent scheme in many industries. And according to some recent cases, the Italian tax authorities claim that the involvement of the foreign parents in the execution of the agreement leads to the qualification of that transaction as an uncontrolled transaction, which of course I think is quite surprising, and we will see a lot of controversies in this matter. The other example is taken from a recent Supreme Court decision, concerns a flow of interest from Itaco 2, an Italian resident company, which paid interest to Itaco 1, applying no withholding taxes, because there is no withholding tax due on domestic flow of interest. And Itaco 1 was paying interest on similar terms to Laxco, but in that case, the EU Interest and Royalty Directive was applicable, and so there was also no withholding tax. Now, the Italian tax authorities have claimed that Itaco 1 was not the beneficial owner of the first interest flow, and have applied to Itaco 1, have disregarded Itaco 1, and have applied withholding taxes based on the rules for non-residents to the interest paid by Itaco 2 to Itaco 1, that is, two Italian companies. Now, what is, I think, astonishing of this, and has generated a lot of debate, is that there is no beneficial ownership requirement in domestic transactions in Italy. So this is extremely difficult to predict. And a wide approach to risk management in tax matters is required. If I can briefly switch to the next slide. I wish to say that very shortly, administrative penalties might be quite high. Depending upon the circumstances, they range from 90% to 240% of the unpaid tax. But that level of penalties is hardly ever paid because there are a number of opportunities to reduce those penalties in case of plain acceptance of the assessment or of a settlement agreement, which the benefits might be further increased in the tax reform in progress. So we will, in particular, we expect to have additional benefits in 2024 and future years for voluntary disclosure violations. Criminal penalties are also quite concerning because in case of missed tax returns, the threshold is as low as €50,000 of missed tax payment. And this is typically the case of unreported PEs, where there was, of course, no return. Less concerning, but still concerning, is the case of plain adjustments of filed returns, which we call unfaithful returns in the criminal law language. And here we have a relatively higher threshold, which is either €100,000 of missed payments and either unreported income higher than 10% of the reported income or unreported income higher than 2 million. So how to conclude, how can the tax risk be effectively managed in Italy, which is the next slide? First, transfer pricing documentation is key. There is a very important penalty protection, so criminal and administrative penalty will simply not be applicable if transfer pricing documentation is timely drafted. Also recommended is the early detection of the PE risk and PE registration. It's much easier to manage an assessment on the income allocation of a PE than to manage a missed registration or undisclosed PE case. We will have, starting in 2024, this opportunity for small enterprises, which, again, let me say, can be also the small subsidiary of a large group, of those biannual preemptive agreement in which the income is defined in advance and no penalty is applicable because simply there will be no inspection. For larger companies, we have the Cooperative Compliance Program, which now is applicable only to companies with a revenue higher than 750 million, which is, of course, quite remarkable, but that will be reduced to 500 million shortly and probably will be brought down to 100 million, which is the same threshold I mentioned in the first slide with respect to the categorization of taxpayers. And then, of course, a due diligence review of at least some critical suppliers for avoiding the denial of deduction of VAT, and in general, also in respect of unpredictable constructions, the periodic review of business models or the preemptive analysis of business reorganization under the anti-abuse rule. So a few points that might hopefully be helpful as far as Italy is concerned.